Well, with that, I believe we'll get started. Thank you so much, everyone, for joining this call on maximizing SNAP benefits. I am going to advance to the first slide of the call and pass the microphone over to Alyssa Munoz, who is the director of the New Orleans Food Policy Action Council, who will start off our call.
Hi, everyone. I am so glad to see everybody here. During your lunch hour, we really appreciate it. This is such an important topic, and we really hope that this webinar will help you all understand a little bit better how to better serve your clients and how to help others who also serve clients who need SNAP benefits. So I want to introduce Danny Mintz, who you all have been hearing from with the Louisiana Budget Project, and Haley Holton, who is with the New Orleans Food Policy Action Council as well. I will be monitoring the chat. So if a question comes up, please pop it in the chat and I will be collecting those for Danny and Haley and answering them when I'm able to. And we will mute everyone. So if you have a question that you'd like to ask in person, please use the raise your hand. And that's at the bottom right, there's a reactions. And you should be able to raise your hand there since we do have such a great group. And again, thank you all so much. I'm really thrilled to see so many people here to learn about this. So with that, I will turn it back to you, Danny.
Okay, thank you so much, Alyssa. And I also want to thank Tracy from the Department of Children and Family Services. Tracy, whose last name was on my screen and then popped away as soon as I clicked over to PowerPoint. So I apologize.
Thank you. I'm happy to be here, Danny.
Thanks so much. It's Tracy LeBlanc from the Department of Children and Family Services. And if there are, we will have a formal question and answer session at the end of our presentation. But if there are any questions that we have as advocates aren't completely sure on, I think Tracy will be a wealth of information and will at minimum be able to point us in the right direction for answers. So with that, please do drop questions in the chat as they come. And I do want to remind everyone that this meeting is being recorded and that we will circulate both the recording of the meeting and the slides following the presentation. So with that, I'm going to pass the microphone over to Haley Holton with the Food Policy Action Council to start us off.
Hi, everyone. Like Danny said, I'm with New Orleans Food Policy Action Council, and I've mostly been working with senior citizens who are eligible for SNAP. And so the key components of SNAP benefit determination is your household size, assets and income, and deductions. The one that I focus on to maximize benefits is the deductions. Those are the most important, especially for senior citizens, due to medical expense deductions and things that we'll get into in a little bit. If you see on the right-hand side here, this picture is a SNAP calculator that has been added to our website. And I think Alyssa just plugged the website in right there. And basically you can have your client answer these questions and it should give you an approximate estimate on how much a household could receive each month and determine if they're eligible for SNAP. And then, yeah.
And I do want to emphasize the SNAP calculator is an extremely useful tool, but it is only an estimator. So you should, if you have a client who isn't sure whether they might be eligible for SNAP or isn't sure how much in SNAP benefits they may be entitled to receive, the SNAP calculator can help to figure out a ballpark. But DCFS is the final authority on making eligibility determinations. I wanted to talk for a second about types of income in SNAP, because that's really key to this question of how we maximize deductions. There are two main forms of ways of counting income that SNAP uses to determine whether someone is eligible for the program, and in non-pandemic times, how much in SNAP benefits they're entitled to receive. The first is something called gross income. The eligibility threshold for SNAP is 130% of the federal poverty line. Federal poverty line changes every year, and it's different for every household size, recognizing that a household of 4 people has greater expenses than a household of 1 person. And we will show a slide with these thresholds in a moment. They're also available on the DCFS website. Gross income is the income that a person earns from work, plus most unearned income that comes into the family. So for example, benefits that come in through SSI or SSDI. And that's a non-exclusive list of unearned income, minus the child support payments that a member of the SNAP household makes. And that's really critical. Child support payments in Louisiana are removed from gross income before that eligibility test happens. So if a household member has child support payments, it may mean, depending on the size of those payments and the household's income, that they're eligible for SNAP after those payments are discounted, even if the sort of large number for their gross income puts them above the income threshold for their household size. The other form of income that's really critical for SNAP is what's called the net income, and that's gross income minus countable deductions. This is important for 2 reasons. Let's say you have a household that when you look at their gross income, it's right at 129% of the poverty line. They may be eligible in theory based on that gross income standard, but if they don't have enough deductions to bring them down below 100% of the poverty line, they're still not eligible for a benefit. The only exception to this is households with members who are 60 years old or older, or who are disabled, who are subject only to the net income test and not the gross income test. Now, I had a brief advocacy sidebar, which is that most states actually use a higher gross income threshold than the federal minimum, which is 130% of the poverty line. 35 states have an enhanced gross income threshold. 18 states still use the federal minimum. And the majority of those states, 19 states that have an enhanced gross income threshold, make eligible families up to 200% of the poverty line if their deductions bring them down below the net income threshold. The reason I wanted to point this out is because this is a change that Louisiana could make to help make SNAP more accessible to working families with high costs for childcare and shelter. This is what the gross income thresholds look like. This is the maximum gross monthly eligibility standard and the maximum net monthly eligibility standard for different household sizes. And I want to emphasize this is true as of today, but this is going to be changing on October 1st. And we'll get into that later on in the presentation.
So claiming deductions can boost benefits. I think you can click again, Danny. I think it has. There you go. Such as shelter costs, medical deductions, childcare. Yeah, so go ahead and go to that next slide. But the deductions must be claimed to be counted. This is really important. A lot of individuals may have expenses that would count as a deduction, but without proof of some of these claims, then usually they won't receive their full benefit that they're entitled to. Like I said, the burden of claiming deductions is generally on the applicant, and so it is important that you are steering them in the right direction on how to get these claims in properly with DCFS to get the maximized benefits for those clients. Maximizing SNAP benefits is extremely important to ensure that people are getting the benefits that they're entitled to receive. We also are trying to increase the participation among eligible seniors. Many seniors are eligible, but they are unaware that they're eligible, or things like a medical expense, which if you're paying over $35 a month, we'll get into in a little bit, can bump some seniors to eligibility. We're also trying to minimize SNAP benefit cuts when the pandemic ends. So usually SNAP benefits are based on income, but during the pandemic, every SNAP recipient received the maximum benefit for their household size, and that is still currently going on. But in the near future, when emergency allotments end, households that normally would receive less than the max benefit will go back to receiving the smaller amount. So it's important to maximize the SNAP deduction so that this isn't as big of a hit or decline in benefits.
And I want to emphasize that we do not know at this stage when the emergency allotments that are currently available in Louisiana will stop being available. They're available as long as both the federal public health emergency and the state public health emergency are in effect. As soon as one of those ends, and it can be either one, then the state is no longer eligible to apply for emergency allotments, bringing every household up to the maximum benefit. And so what I think is the critical message now is that, during the pandemic, DCFS made a lot of changes and introduced a lot of flexibilities to try to get as many people who are facing food need into the door as possible. One major thing that was sort of pushed aside so that applications could be processed as quickly as possible was the SNAP interview in most cases. And as a result, you may know many SNAP recipients who applied earlier in the pandemic for the program didn't necessarily have a point to talk with a caseworker and find benefits they could be eligible to receive, and may face a pretty sharp reduction in SNAP benefits once emergency allotments end. So now is the time to start talking with clients about whether they have medical expenses or other deductions that we'll talk about in a minute, and starting to get together proof, if necessary, to send to DCFS to make sure that clients get all the benefits they're entitled to receive. And just again, to reemphasize, SNAP benefits are currently being provided in a maximum allotment to every household. So a 4-person household gets a benefit of $782 as long as they're qualified for SNAP benefits. At some point in the future, that benefit will vary depending on their income, between a range of, for 1- and 2-person households, $20 up to the maximum benefit for household size, and for larger households from as low as a single dollar up to the maximum benefit for their household. So here's some quick SNAP math regarding how deductions boost benefits. Let's say you have a family of 4 earning $2,800 a month in gross income. Well, just for the sake of argument, we're going to say all this is earned income. This is very close to the eligibility threshold for a 4-person family, but they still qualify for the program, and they have substantial costs. For dependent care, they pay exactly the average out-of-pocket cost of care per child in Southeast Louisiana. That's $467 a month. For rent, they happen to pay exactly what is estimated as fair market rent for a 2-bedroom apartment in New Orleans, $1,061, plus they have separate utility costs. Before these deductions are taken into account for shelter and childcare, they would receive, under normal times, $218 a month in benefit. But with these deductions, their benefit more than doubles to $537 a month. And as we look toward the end of the pandemic and the end of emergency allotments, what we're talking about when we're talking about maximizing deductions is potentially the difference between a household of 4 receiving a bit over $500 a month to purchase groceries, and that same family receiving only a bit over $200 a month to purchase groceries. So there are some deductions in SNAP that are automatically applied, and we're going to get into these in detail in a second. Those are the standard deduction, which doesn't differ by anything but a family's household size, and the earned income deduction, which is a function of how much a family makes through work. There are other deductions, however, that must be claimed, and that's going to be the focus of much of today's presentation. Dependent care expenses, excess medical expenses, a homeless shelter allowance if every member of the household is homeless, and excess shelter costs. That is the cost of shelter that are more than half of what a family brings in after other deductions are taken into account. So the standard deduction varies. It's a fixed amount, but it varies based on household size. And the earned income deduction is simply 20% of all income that the household receives from either a job or self-employment. I'll talk a little bit about self-employment. We're not going to go into too much detail about that. But if you do have questions regarding self-employment calculations or anything else that we're covering, please either add them into the chat or simply unmute and interrupt, because Haley and I both, I think, could talk forever. We're very happy to take questions in the moment. Self-employment income, very quickly, is profits that come from self-employment. We're going to provide some more details in a second. And just a quick advocacy note, there are 23 states that use an alternative method rather than looking directly at costs of doing business for calculating a self-employment deduction. Self-employment deductions can be complicated to administer. The documentation requirements are quite stringent, and depending on a household business's accounting practices, the household may or may not have all of the information needed to claim the true benefit amount they're owed to hand. So that may be an option for policy change in the future in Louisiana. DCFS determines and I just want to emphasize, this may apply to a minority of your clients, but for those clients who are self-employed, understanding the self-employment rules can be really critical. DCFS determines self-employment income by adding gross income from self-employment and any capital gains from the sale or transfer of capital assets, and then subtracting allowable business expenses. If necessary, let's say somebody has self-employment income that comes in roughly once a quarter, that's averaged out to a monthly basis to determine SNAP eligibility. And I just want to note for a second, we have links on all of these slides to the DCFS policy manual, which goes into even more exhaustive detail than we are able to on these specific questions. If you have additional information that you'd like to find, you can find them in the links in this slideshow when we send them out. And we've tried to link only to the specific pages of the policy manual that are relevant to each slide. Allowable deductions are essentially business expenses, costs of advertising, labor, stock, raw materials, etc. We won't go through this slide in great detail, but I wanted to make sure that it was available for everyone as a reference in the future. Very quickly, are there any questions from folks on the call about any of the material that we've covered so far? Okay. Well, once again, I do want to emphasize we are giving a lot of information on this call. That's because it's so important that you know all of the possible deductions available to SNAP clients. So with that.
All right, so dependent care expenses is an expense that would cover, or an expense that could be deducted if a household is trying to pay for the full cost of childcare or care for a dependent adult, so that the individual can attend work or school, look for a job, or attend training for jobs. Transportation expenses are also counted, so you can deduct mileage that is used to transport the individual needing care. This deduction does not need documentation unless there are expenses greater than $500, or if the expenses are for some reason questionable, or if there's a change in these expenses that could increase the benefits of the household.
And just to clarify, that the change would be something, let's say you have a SNAP client who's already applied for and is receiving benefits, and they have new childcare expenses. If they report that new expense to DCFS and it's going to increase their benefit amount, they would need to submit documentation for that. And the transportation costs, I think, are really important. Let's say you have a 2-mile drive to and from your child's childcare facility every day, and you need to make that drive to go to work, you can be reimbursed for the full round trip. That's 4 miles at the state reimbursement rate, which is currently 56 cents a mile. You can also claim the actual cost, and that's as long as you are using your own vehicle. If somebody is taking their child to childcare, or an adult dependent to dependent care in a Lyft or an Uber, that's also a claimable expense. It's a good idea to save receipts when that expense exists.
Excess medical expenses. This one's particularly important in senior households or households with a member that is disabled. The requirements are that they have to be 60 or older or have a disability, and that can include any member in the household. So you just need one member in a household to be 60 years or older or have a disability to claim a medical expense deduction. The household must also spend more than $35 a month on their medical costs. And this must be something that they are spending money on, not something that someone else is paying for. Documentation such as receipts, that I'll also get into this more on the next slide. Receipts of like prescriptions, any medical equipment, that kind of thing are needed to receive this deduction. And so you need to make sure that your client either has copies of these or can get them from like their pharmacy or somewhere of proof, and you want these to be as recent as possible so that the cost is fully covered if it has changed at all in the last few months. This deduction is also not capped unless it reaches the max allotment, but that is usually pretty rare for it to reach the max allotment. Here are examples of anything that would be covered under a medical expense deduction. So prescription drugs, medical supplies, over-the-counter medication, if it's approved by a health professional, medical and dental care, and this also includes psychotherapy and rehabilitation, hospitalization and nursing home care, health insurance premiums, deductibles, and copays, including Medicare, dentures, hearing aids, including the batteries for hearing aids, and prosthetics, service animal expenses, including the vet bills and their food, prescription eyeglasses and contact lenses, transportation and lodging costs to obtain medical treatment. So again, that whatever expenses you are using, be it mileage or some sort of transportation company, you can deduct that as well. Attendant or home health aid, and then accommodation equipment added to a vehicle or home.
And we have received a few questions in the chat, some of which I want to ask Tracy if you'd be able to weigh in on. And I'll read the questions out. The other thing I wanted to emphasize just before we get there is just that the category of medical excess medical deduction is quite expansive. There are a few things that are excluded, but it can dramatically change a household SNAP benefit. So the first question is regarding the definition of disability. Is disability determined by Social Security, or can it simply be doctor documented? And Tracy, are you able to weigh in on that question about how DCFS makes disability determinations for the purpose of SNAP? Oh. And Tracy, I'm sorry, I think you're still muted, but you should be able to unmute yourself.
I am still muted. I'm very sorry. Okay, if you give me 1 minute, I will pull the policy up and I can answer the question straight from our policy.
Very good. And while Tracy is pulling up that policy, I will answer. Somebody asks, let's say you have an expensive surgery or imaging that's done every 6 months. Can it be averaged out over several months? My understanding is that the answer is yes, that if there are medical expenses, you can't claim medical expenses that are delinquent. Let's say you had an expensive surgery several months ago and the client has been unable to make payments and that expense is now past due. I believe SNAP rules don't allow claiming that for that expense. Although Tracy, please correct me if I'm wrong.
No, that is correct. If it is considered delinquent, it cannot be allowed if it is considered delinquent by the provider. But there are ways that the medical deductions, like budgeting anticipated medical expenses, if the household reports anticipated medical expenses at the time of certification, but is unable to provide verification at that time, They can report the expense and provide the verification whenever they are able to, and households may elect to have fluctuating medical expenses averaged if regularly recurring, reasonably anticipated, and verified. Workers must routinely average bills from past months, but should use these only as indicators of anticipated expenses. There's also part of our policy that allows for a one-time medical expense, and there's certain criteria that have to be met. For instance, if it's billed in the current certification period, or it was billed prior to initial certification and is unpaid but not delinquent at the time of certification, it was billed in a prior certification period, was not allowed in that certification period, and is unpaid but not delinquent at the time of the redebt, or it was billed in the last 2 months of the prior certification period and was reported but not budgeted in that certification period. So we do have several options in that regard that we can address, depending on the situation and depending on exactly what is being reported and how often it's occurring, and so on and so forth.
And Tracy, I actually have another question kind of off of this. Just to clarify, when an individual is spending more than $35 a month, but that also includes an attendant or home health aide, someone in the home that would possibly also qualify as a dependent care deduction, what should we be telling our clients? Should we be telling them to count it as a dependent care, or should we be pushing for the medical expenses? Is there one that's going to end up being better than the other?
Let's see, 1 second. We have a section on that. If the client reports caretaker costs that could qualify under both dependent care and medical deductions, the household must be allowed a deduction of either dependent care or medical expense, but not both. So it would depend on which one was more beneficial to them, depending on their situation, depending on what other medical expenses they possibly are reporting. They would have to look to determine which would be most beneficial, because that is our goal. Our goal is to allow what is most beneficial to the client. Mm-hmm. So each individual situation would have to be reviewed to determine which is better for that particular person, depending on what other expenses they're reporting.
And thank you so much, Tracy. And I wanted to, and I believe neither of those deductions is capped. So there should be, there's no cap for dependent care expenses, and there's no cap for excess medical deductions, except that you can't get over the maximum benefit amount for your household size. So I just wanted to clarify that for everyone on the call. And I wanted to ask, just in terms of how disability is adjudicated, how does DCFS determine what counts as disabled for SNAP eligibility and benefit calculation?
Okay, I was pulling that up. I'm sorry, I got sidetracked with the other question.
No problem. Thank you so much for looking this up on the fly and for all the information.
No problem. I'm very happy to help.
We've had a couple questions in the chat about if these slides will be made available. They will be made available shortly after the presentation.
And to Laura's question,
don't just have to take notes on this all at once.
To Laura's question about whether the caseworker calculates each option with the applicant, based on the way that the policy manual is worded, it sounds like the applicant would request that that a particular deduction be allowed either as excess medical or as dependent care. But I will say there's no multiplier associated with either one of these. So, in my understanding of the benefits calculation, with the exception of that sort of $35 sort of subtraction for initial excess medical deductions, I don't think there would be a substantial difference in the benefit amount whether dependent care expenses are counted as dependent care expenses or as excess medical expenses. I think the benefit calculation would be the same. The key point is that if something can plausibly count in both categories, one has to be chosen. They can't be counted twice. But I don't believe that there would be a substantial difference in a client's ultimate benefit amount, whether an expense is counted as excess medical or as dependent care.
Yeah, and to go off of that, essentially it is on the client to make sure that they have all of their receipts or information. So that's where I would say a caseworker would be the one to calculate, probably where it would go in terms of if it overlaps with dependent care or medical care. But either way, just make sure that that client puts in any information that they think could be deducted. So just make sure you have that proof, which I'll be going over in the next slide anyways.
And that is exactly right. And the caseworker should be able to evaluate if one is more beneficial to them to the other and explain that to them. So in regards to disability requirements for SNAP, there's a number of things. What our policy reads is consider as disabled for SNAP purposes and entitled to special consideration when determining eligibility and benefits. Any person who is receiving supplemental security income, also known as SSI, or Social Security benefits based on a disability or blindness, or receiving federally or state administered supplemental benefits under Section 1616A of the Social Security Act, provided that the eligibility to receive the benefits is based upon the SSI disability or blindness criteria, or receiving federally or state administered supplemental benefits under Section 212A of Public L 93 through 66, which is the mandatory minimum state supplementation, or receiving disability retirement benefits from a government agency because of a disability considered permanent under the Social Security Act, or a veteran with a disability rated by Veterans Administration, also known as VA, as total or paid as total by the VA under Title 38 of the United States Code, or a veteran considered by the VA to be in need of regular aid and or attendance or permanently housebound under Title 38 of the United States Code, or a surviving spouse of a veteran and considered by the VA to be in need of regular aid and attendance or permanently housebound, or a surviving child of a veteran and considered by the VA to be permanently incapable of self-support under Title 38 of the United States Code, or a surviving spouse or surviving child of a veteran is receiving or has been approved to receive compensation for a service-connected death or pension benefits for a non-service connection death under Title 38 of the United States Code and has a disability considered permanent under the Social Security Act, or receiving an annuity payment under Section 2A.1.4 of the Railroad Retirement Act of 1974 and is determined to be eligible to receive Medicare by the Railroad Retirement Board, or Section 2A.1.V of the Railroad Retirement Act of 1974 and is determined to be disabled based upon SSI criteria, or eligible for SSI benefits based on presumptive eligibility and SSI emergency allowance payments, or eligible for disability benefits from SSI or VA, but not receiving because of 100% recoupment, or receiving disability-related medical assistance under benefits of Title 10.110 of the Social Security Act. So as y'all can tell, there's a lot of different things that could actually, have someone considered, as disabled by the SNAP program.
And that, there's clearly a lot of specific and detailed information that is necessary to understand the disability reporting rules. So I just want to let folks know I did post the section of the policy manual discussing this in the chat. And before we circulate the slides, we will also add in an additional slide, probably an additional several slides that include this more specific information about disability determinations. But I believe the short summary would be that if you have a client who does have a disability determination from another state or federal agency, then chances are, I don't want to be entirely definitive, but chances are that they would count as disabled for SNAP, and that you should be able to check that aspect of the policy manual for the specific qualifiers for disability.
And correct me if I'm wrong, but in the medical deduction, is that solely for seniors and disabled, or is that's what my understanding was?
For medical deductions, a household is allowed a medical deduction for a portion of the medical expenses over $35 a month per household if the expense is incurred by any household member who is age 60 or older or disabled as defined by the policy I just reviewed.
Okay, yeah, just double checking because I know someone had a question about their children in the chat. Okay.
Now, if a child receives SSI, they're disabled. So.
Yes.
All right.
So, so with that, we're going to go on to documenting medical expenses. And thank you, Tracy, for that very detailed response. It is much, much appreciated.
You're very welcome.
So again, documents that might prove your medical costs are prescription printouts, and you can get these from your pharmacy for documenting the cost of medication, receipts prescribed for medical expenses, and Uber, Lyft receipts or transportation costs to and from medical facilities and appointments. And it's noted on here that online maps showing mileage between home and medical facilities along with dates of appointments facilitates as proof. Health provider bills, including copays and date of service. Bills are statements of insurance premiums and deductibles, and bills from home health aides and care services. So you'll want a copy of each of these, and make sure you're making copies so that you're not losing your only, your main source of proof in case something ends up getting lost. You want to make sure that you're turning in copies and not your original documentation. You can go ahead and go to the next slide, Danny. So on this slide, I don't have to go over it in detail with y'all, but this is how you submit your documentation, and this is extremely important. So after you have a client fill out an application, you need to make sure that you have them either upload it to the LA Cafe self-service portal, which is the quickest way to get this done, but it has to be in PDF format. And so individuals need to upload documents such as in a way of like scanning them onto the computer, putting them in PDF format, and then uploading them. There's a spot on the portal there to do that. If this is too difficult or they don't have a portal for some reason, you can email documents to dcfs4u@la.gov or fax them. You can also mail in copies. Again, don't use your original documents, and make sure that you're putting the client's full name, social security number, and case ID on the document so that it doesn't get mixed up with someone else. Or you can bring copies to the local DCFS office, but just know that this is a critical step. That proof needs to be submitted in order to possibly get the max benefit.
And we do know that some clients don't have a social security number, but they have a pseudo social security number generated by DCFS. If you have access to that pseudo social security number, then you should include it on documents that you send in. If not, I think the name and case ID at minimum will help make sure that the document gets where it needs to go.
So shelter costs are another thing that can be deducted. So cost of shelter in excess of 50% of the household's income after all other deductions have been applied. So they can allow for deductions after 50% of the household's income after other deductions. Sorry if that's not clear. It's
Well, this is I think
the way that I'm saying it in my head.
this is a really critical point, I think, because the shelter costs are the household income that goes to determine what's allowable as a shelter deduction is only determined after other deductions are applied. So unless if the family shelter costs are under the deduction cap, and then claiming other deductions also ultimately increases the value of the shelter deduction, because it means that the income that's being counted towards that determination is smaller. Yeah, Haley, when I say it, it's not any clearer.
Yeah, it's like something that makes sense in my head when I read it, but it's harder for me to explain it out loud.
Does anyone on the call have a question about that, or want to try and say it in your own words if you feel you have a sort of pithier way of explaining that? Please feel free to unmute. Okay, well, please feel free to ask a question if it's unclear. Yeah, Haley, go ahead.
So after you make all of your original deductions like medical expenses, employment, all of these other deductions, then when you're looking at just your household income after that, if your cost for shelter is, oh wait, now I'm losing my train of thought, is
greater than half of the available income.
Yes. Then you would claim a shelter deduction. This can include rent or mortgage, property taxes, insurance. This includes PMI insurance, condo fees, homeowners association fees, installation charges for fuel, utility, and sewerage. Generally, there's a standard utility allowance, and this is about $350 with heating and cooling, or if an individual is not paying for heating and cooling, it's about $193. And if an individual is only paying for a telephone, it's $46. This is a standard deduction amount, and so this will generally be applied for anyone who is renting or paying mortgage. So this is if utilities are, if they're not included in your rent or mortgage. Important notes that shelter costs are verified only if questionable as well. And they're capped at $586 unless you're in a household with an elderly or disabled member, in which case there is no cap. Households with an elderly or disabled member claiming excess medical costs can also boost shelter deductions in the same way that Danny said earlier, that lowering the cost.
And I just want to very quickly address the question that Cynthia asked in the chat. If an elderly person owns land with other family members, but the elderly person meets requirements, is the value of the land counted? I think there are two ways to interpret this question. Does the land count as an asset? The answer to that is no. Both because in general, Louisiana doesn't impose an asset test for SNAP except in certain limited cases, and because there's no asset test for elderly households. So if somebody is 60 years of age or older. In terms of the costs of maintaining that land or making payments on that land, if it's land that the elderly person lives on and is their primary residence at the time that they apply for SNAP, then to the extent that they're still making mortgage payments on the land, insurance payments on the land, a standard utility allowance if they have heating and cooling costs, all of that would count towards a shelter expense. If it's land that they own but don't live on, there are different rules that apply, and I'm not as familiar with those. I'm just looking quickly at the time. We have about 13 minutes left in the call. And so I think what we will do, because that's a more complicated question, is move on to subsequent slides and then come back to it if we have time at the end, just to make sure we cover all the material. And just very quickly, Kim says there's no asset test for people over 60. Yes, in general, in SNAP, there is not an asset test for households with elderly or disabled members. And Louisiana uses a policy called broad-based categorical eligibility to eliminate the asset test for most SNAP applicants. There are certain situations where broad-based categorical eligibility doesn't apply. That kind of goes beyond the scope of this call, but we'd be happy to direct folks to appropriate resources. Please do, we're going to push ahead, but if some of these questions weren't fully answered, please do ask them again or ask for clarifications when we get to the Q&A. Oh, and this is my slide. So there's also a deduction, a homeless shelter deduction for households where every member is homeless and where that household has shelter costs. These costs can be claimed without documentation. Essentially, these are the costs that come with living unhoused. So it can be a cost of like a nightly entry fee into a homeless shelter, or the cost of if you have laundry costs for doing laundry at a laundromat, if you have car payments and you're living in your car. All of these can be used to claim the standard homeless deduction. And the SNAP definition of homelessness is living in a supervised shelter designed to provide temporary accommodations, living at a halfway house or similar institution, finding your accommodation in somebody else's house for a temporary period, couch surfing is an example of this, or living in a place not designed or ordinarily used as a regular sleeping accommodation for people, such as a hallway, a bus station, a lobby, or a similar place. The homeless shelter deduction is a standard amount of $147.55. Or if a homeless person has actual shelter costs higher than that amount, they also can claim those higher shelter costs. They do have to be verified. So an example of this would be if someone is living in their car and are making car payments of $200 a month, that would be a shelter cost above the standard homeless deduction, and would have to be verified, but it would be advantageous for that homeless household to claim their shelter costs rather than the standard deduction. So I want to go back to our earlier SNAP math slide to show how another deduction can help significantly increase the amount available to a family. If we take our initial family of 4 with one disabled adult, let's say that their dependent care costs are the same as the cost that we said earlier, and the rent is the same as the cost that we said earlier. They're getting the standard utility allowance for the separate utility costs that they pay. But they also have $150 in medical costs between their copays for medical treatment and the transportation to and from medical appointments. That, including those medical costs, increases their SNAP amount from their SNAP benefit amount from $537 a month to nearly $600 a month. And that is simply from claiming the $150 of monthly medical costs. That's a significant difference for the family's ability to meet their grocery needs from month to month, and I think is a useful example of how these deductions can help. Obviously, if medical costs are higher, then the changes to benefits are higher as well. So it's certainly to families' advantages to claim and to document these expenses as deductions when available. Finally, we wanted to give a brief note. We're giving this presentation today on September 29th. And I'm saying this partly for the people on the recording. On October 1st, SNAP benefits are changing and are rising. And they're changing in a number of different ways, but the net effect is that SNAP households are going to be seeing higher benefits. So Congress passed legislation earlier in COVID, bumping everyone's SNAP benefit up 15%. Those are going to end on September 30th, but the USDA also reevaluated something called the Thrifty Food Plan, which is really the basis for determining what the SNAP benefit amount is. And what they found is that that calculation didn't really reflect the costs of a minimally adequate diet today. It was based on on studies of household food use conducted in the 1950s. So they looked at how people buy food now, what sort of time is available to folks to prepare meals, how often people are actually cooking from dried beans. The old formula imagined a very, very bean-heavy diet, which simply doesn't reflect reality, contemporary reality. And so as a result, when they reevaluated the Thrifty Food Plan, SNAP benefits are increasing by 21% starting on October 1st in just 2 days. That increase is permanent, but because it's coming at the same time as the earlier 15% increase is expiring, most households will see a comparatively small bump in their monthly benefit, roughly $12 to $16 per person in total. As we mentioned earlier, at some point in the future, although we don't know a date yet, the emergency allotments that are giving all households the maximum benefit will expire, and that is when claiming deductions is going to become immediately important to households. So that takes us to the end of our presentation with a full 7 minutes to spare. So we would like to take any questions that you may have, details that we didn't discuss, things that we covered, but you just want to go into in more, either again or more specifically, and questions that Tracy LeBlanc might also be able to respond to from a DCFS perspective. And with that, I'm going to stop talking.
I think, Tracy, if you're able to, if you can look at the question about the land ownership. I know that's beyond my scope of things. I'm currently looking in the manual, but that might be a better answered question straight from DCFS. But if there's any other questions that we can assist with, either put them in the chat or unmute yourself.
Well, I think Danny mentioned it earlier in regards to our broad-based categorical eligibility policy that's in place right now. That policy allows us to disallow resources that would normally be counted. And so therefore, it gives us a lot of leeway that we did not have prior to the implementation of that policy. That policy has been implemented before, and normally it would be implemented, and then unfortunately, the policy would change. It would no longer be implemented. But as of right now, that policy is implemented. And so there are some who are not eligible for it. There is a listing in our policy. We could look, because there's some caveats. We'd probably have to look at the individual situation and exactly what is the household situation in order to, give a specific answer regarding that. It's not one of those just, across the board, yes or no, unfortunately, answers.
And there's a question from Jordan asking, is it possible for their SNAP outreach coordinator, who's a DCFS community partner, to get a liaison at DCFS for when she has questions, so that she can talk with someone at the agency directly? Tracy, do you know the appropriate contact for the community partners to reach someone at DCFS?
I actually don't, but it's definitely something I can find out.
Excellent. So we, in our follow-up to this call, will include in an email the appropriate contact at the agency. Well,
see Bryn plugged in the next FPAC meeting, October 14th. So if anyone is interested in joining, the link is right there in the chat.
And if you would like to contact us with any questions or comments, you can reach Haley or me at the addresses or phone numbers on the screen. For additional context, I probably should have said this up front. The Louisiana Budget Project monitors and reports on policy that affects low and moderate income households in Louisiana. A lot of our work is advocacy around safety net programs and state budget and tax issues. You can find more information about the Budget Project at labudget.org. And Alyssa, would you like to give a plug for FPAC?
Sure, thanks. FPAC works on policy and systems change in the greater New Orleans area and to some extent in Louisiana as well. So we do a lot of policy advocacy. We do a lot of what I call policy translation. So kind of what we did here today about, making policies a little more understandable to people and especially policy changes. And we also provide a space for organizations working in the food system to network and collaborate. And so we have an FPAC meeting coming on October 14th. We put the meeting link in the chat. We would love for y'all to be there if you'd like. We always have other organizations there, like-minded organizations, and we do policy updates. Yeah, the Zoom link says September 9th because it's a recurring meeting. So it is October 14th. Apologies. Technology will not, the revolution will not be done via Zoom.
And thank you again so much, Tracy, for participating in the call. It was invaluable to be able to have authoritative answers from DCFS to some of the questions that were posed today. Thank you, everyone, for sticking with us through what was a very dense presentation. We sincerely hope that it was valuable for you in your work and for the clients that you serve. And once again, please don't hesitate to be in touch. We'll send out the slides and the recording of this presentation as soon as the recording is fully processed. Thank you again, everyone.
Danny.
Oh, and Tracy, sorry, go ahead.
I'm sorry. I actually, thank you. It was my pleasure to participate. I actually have an answer to that question regarding a contact. So Chiquita Nutter would be the contact person, and anyone can email her and copy Amanda Skinner.
And Tracy, can you please, if you can either type their email addresses in the chat or
I can definitely do that. Let me just
perfect.
pull them up and I can absolutely do that.
Well, and with that, since we have a moment while that information is being entered, just as part of the broader Louisiana Budget Project mission, I want to make sure that everybody is aware that this week Congress is considering very important legislation that impacts child nutrition in particular. Some of the legislation that's being considered as part of the Build Back Better plan and that's currently being debated in the House includes an increase to reimbursement rates for schools providing school meals, more flexible and accessible standards for states and local educational authorities to serve free meals to all children, and a permanent expansion of the child tax credit, which, based on the temporary child tax credit that was enacted as a response to COVID, has had a tremendous impact on families' abilities to afford full nutritious diets. That is estimated alone to cut child poverty in Louisiana in half on an annual basis. So that is being considered now. If you're inclined, it is a great time to call your representatives in Congress to let them know what that sort of change would mean to people in Louisiana. So a brief and not entirely related plug from the Budget Project. Thank you again, everyone. We are right now at 1:02. I appreciate everyone sticking around and look forward to sharing this material with you in the future. Take care.
Thank you.